Shortly, we'll be heading into the SAVCA Private Equity Conference for 2026, which focuses on Southern African private equity and also some venture capital. And ahead of this, tomorrow and Wednesday, I've been reflecting a little bit on what actually came out in an audience poll from the recent Bain Private Equity Global Outlook webinar they hosted. Because again, I think this offer that offers quite an interesting and very useful snapshot on where the market is currently. And I think what makes the results so interesting is that they don't just tell us what people hope will happen, but they tell us how the market participants are actually reading the private equity environment right now on a global scale. And the message for me, for me at least, is quite clear. The outlook is improving, but conviction really remains measured. Now, if we start with the first poll that they put forward in the webinar, the results that we saw on the expected deal volumes for 2026 relative to 2025, the dominant view from the audience was that not that the market is about to surge, but most respondents expect the deal activity to increase modestly and remain broadly flat. Only a very small portion expected a sharp jump. Now, of course, this matters because it suggests that the market is not yet pricing in a dramatic rebound. Instead, it's pointing to a more selective recovery, one where capital is available, activity is possible, but discipline is still very important. The second poll question was on buyout and buyout-backed exits, and I think it tells a very similar story. Again, the expectation is not for a major breakout here, and most respondents saw exits improving moderately and staying around the current levels. But again, this tells us that while the exit market is reopening, participants still do not see it fully normalizing. And again, I think this is exactly the right way to sort of read the market and what we are seeing on the ground. We're no longer in the deepest part of this dislocation, but nor are we in an environment where sponsors can assume that every quality asset will clear quickly at yesterday's valuation expectation. And of course, this then leads us to, I think, one of the most revealing poll results of all, when asked what best explains this extended holding periods we are seeing in buyout portfolios. By far the largest group, and this was around 66%, said that sellers are unwilling to transact below current portfolio marks. And again, this is also a very important signal because it says that the main constraint is not simply lack of buyer interest, but it's not the primary, and it's also not primarily macro uncertainty. It's also not mainly geopolitical risk. It is not even mostly about weak business performance. It's really this valuation gap. So in other words, many sponsors still believe that selling now would mean realizing value below where they believe the asset should trade or below where it's currently marked. So they hold for longer, continue working the asset and waiting for either earnings to grow into the valuation or the market conditions to improve. And again, this has a major implication for the whole private equity ecosystem. Longer holding periods, delayed exits, slow distribution to LPs, slower distributions affect fundraising, and that in turn shapes deployment, portfolio strategy, and overall cadence in the market. So again, from the Bain webinar, the results are telling us that private equity outlook is not simply about whether the market is open or closed, but it's about how liquidity is achieved is still a very selective environment. And that's why the type of exit route remains so much right now. What we're seeing globally is increasingly a market, and again in the market discussions more broadly, is a more varied and engineered exit environment. So sponsors to sponsor deals, strategic sales, IPOs for the right assets, continuation vehicles, some GP-led solutions, some minority sell downs, and also then structured liquidity pathways. So looking at some on balance sheet options, and the market is moving, but it's moving through very selectively and structured, not through your what can be referred to as easy exits. Um, the fourth poll that Bain put forward in the webinar, the result is also very important because it shifts the conversation from market conditions to what firms can actually control. So when asked where the biggest remaining upside sits in the current portfolios, responded pointed first to revenue growth, then to margin expansion, and then to M&A. And again, here's also something I think very constructive that this is telling us is that sponsors still see meaningful value creation and potential upside inside the portfolio itself. They're not only waiting for multiples to recover, they believe there's more work to be done on the pricing, the commercial excellence, the operational improvement, cost productivity expansion, and obviously also then bolt on acquisitions. And for me, that's one of the most important messages that we can take away, but I think we'll also see at the conference, at the Southern Africa Venture Capital Association conference, this message should also be clear. Again, the SAFRA conference is not just a discussion about sentiment, but it's a discussion about how private capital actually performs its role within the region and within this emerging market, and how it funds businesses, supports management teams, creates value, and ultimately exits and recycles that capital. So that framing is central to the upcoming conference, and its own positioning. Now, so what, in short, what does the Bain webinar really suggest, and what am I going to be listening for at the conference? Well, I think generally, and you've actually had a few discussions about this in the run-up earlier today, is about exit readiness or funding, and linked to that funding readiness. And so again, if exits are improving only gradually, then firms will need to be much more deliberate about how they prepare their asset for sale. This means earnings quality, governance, reporting discipline, management depth, and a clear equity story all become very, very, very important. The second is valuation realism. If holding periods are being extended because sellers don't want to transact below mark, then one of the core questions for the market is, when does patience actually create value, and when does it merely postpone a repricing conversation? The third is operational value creation, and that's definitely back at the center of the private equity discussion and performance. If the main upside remains revenue, margins, M&A, well, then the winners in this market will not just be the firms with access to capital. They will be the firms that have the strongest operating capabilities and the clearest playbooks for building a exitable business. The fourth is buyer and the liquidity universe, which is also evolving. And I think this is no longer only a story of trade buyers versus sponsors, but it's increasingly a story that includes your secondaries, your continuation vehicles, private debt, alternative debt, structured solutions, and more creative routes to liquidity. So for banking and from a banking and deal making perspective, this is also highly relevant, because in the market like this, capital on its own isn't enough. Well, what matters is the ability to structure, to align the buyer and the seller expectations, to support value creation, and to match the right asset with the right exit route. So my reading of the Bain Private Equity 2026 outlook, and also listening to some commentary from the webinar, is that the market expects improvement, but not exuberance. Deals may rise, but probably modesty. Exit may improve, but again, selectively. Holding periods are still being shaped mainly by valuation tension, and the most credible path to better outcomes remain active value creation inside the portfolio. And this is exactly what I'm expecting we'll also hear in the conference. So it comes at a moment when the industry is not looking for for rhetoric or slogans, just looking for practical answers. How do we get transactions done? How do we create value in the slower environment? How do we prepare assets for exit? How do we recycle capital into the next wave of growth, specifically from a Southern Africa and Africa context? So yes, ahead of the conference, very excited to look at what conversations come, and I'm certain a lot of these themes will be repeating themselves. Thanks for listening.